Hi, I'm Ryan, and thanks for tuning into Market Lab. Today's video is part one of a two-part series on the main ways to value a company, namely the discounted cash flow model, or DCF, relative trading multiples, and precedent transactions. I'm excited because today's video is on the DCF, which is one of my favorite investing concepts. Also, if you want to follow along at home, check out a link in the description to a downloadable DCF template you can play along with. All right, let's get into it. Before we get too far, I think it's important to start by pointing out that there's a lot of different ways to value things because there's a lot of different ways to look at what value is. In the case of a relative trading multiple valuation, we are saying that the value of the company should be externally determined based on what individuals are currently paying for similar companies. This is like saying that your car is worth X because it's similar to your friend's car and your friend just bought it for Y. In a leveraged buyout or LBO model, the value of the company is equal to how much a financial buyer, like a private equity firm, would be willing to pay for it in order to get a sufficient target return. In this case, it's like saying that your car is worth X because a used car dealer would be willing to pay that much for it so that they could make a certain amount of money by fixing it up and then selling it. In the case of a DCF, however, the value of the car is more reasonably looked at as the value you get from not having to walk or take the bus every day to school or work, which I think is a bit more honest way to look at things, but ultimately very subjective. When we talk about value in this way, we are talking about what is typically referred to as intrinsic value, the underlying value of something which often bears little relation to its value in the market. In the case of an entity that represents a stream of cash flows, which is essentially all that a company really is, its value is the net present value of these cash flows. What is net present value? Well, to understand that, we need to spend some time on the discounting in the discounted cash flow model. We could do a whole video on discounting, but the short version is that discounting future values means applying the time value of money to them. They say a bird in hand is worth two in the bush, and $100 today is worth more to me than $200 20 years from now. The further we go out, the less that money is worth. The rate at which something declines is its discount rate. Making up an example, let's just say that your personal discount rate is 10% per year. If someone offered you $100 today or $110 next year, you would be indifferent between the two. Same if they offered you $121 in 2 years or $133 in 3 years. Flipping this around a bit, let's imagine that we had a stream of cash flows owed to us. Say we sold a business to someone and instead of paying for it all up front, they owe us $10,000 a year for 4 years. If our discount rate was 10%, then how much would that stream of cash flows be worth to us today? Adding all the discounted terms here together gives us a total value of around $31,700. This is the net present value of those cash flows. Essentially, this is all a DCF is, but we still need to figure out two more important things. What discount rate to use for a company, and exactly what cash flows will we be discounting. The discount rate we use for a company is called its weighted average cost of capital, more commonly referred to as its WACC. It's a weighted average because it takes into account the portion of the company's capital structure from different sources, namely its debt and equity. In our example here, let's imagine a company with $50 million of bonds trading in the market and $75 million in shares. This would mean that 60% of the company's capital is controlled by its equity holders and 40% by its debt holders. As for the cost of capital part, this refers to the expected return that both debt and equity investors should be expecting for their given level of risk. In the case of debt holders, finance textbooks will tell you that the pre-tax cost of debt is equal to the interest rate on a risk-free bond, like a treasury, and then adding a default premium. In practice, we usually just look at the interest rate the company is currently paying on its debt. For example, if a company has a 10-year bond trading in the market, I'd normally just take the current yield of that. However, as we see here for Apple, bond yields are very low at the moment compared to the historical 10-year bond yields in the 3 to 4% range. Ideally, we'd want our cost of debt to be reflective of a more normalized long-term rate, so in this case, we might be more comfortable taking a figure of 3.5%. Importantly, since interest payments on debt are tax deductible, we actually lower this value by multiplying it by 1 minus the tax rate. This is the debt tax shield and is one of the main reasons that using debt to finance a business is attractive, as it is typically cheaper than equity, but it does come with increased risk of default. Continuing with the Apple example, they stopped giving guidance last year because of COVID, so I'm just going to take last year's tax rate. Okay, so we're almost there. Last up is how do we figure out what the cost of equity should be? Well, that's a bit tricky, and if I can be perfectly honest, I don't love the answer. Trying to figure out what the appropriate rate of return required for owning a company's shares has been debated and contested for decades. The mainstay for calculating a firm's cost of equity is the capital asset pricing model, or CAPM. William Sharpe, of Sharpe ratio fame, put the idea together back in the 1960s based on the work of several others, including Harry Markowitz, who's like the godfather of portfolio theory, both of whom split the 1990 Nobel Memorial Prize in Economics for it, so obviously it was kind of a big deal. I won't go into detail on the CAPM model, but basically what it says is that the expected return for an investment is equal to the return of a risk-free asset, typically we use the 10-year US Treasury, plus a risk premium represented by the market multiplied by a figure representing how risky the stock is relative to the market, which we call beta. This market risk premium is essentially the difference between the expected return of the market less the risk-free rate. What it is saying is that if you're willing to endure the volatility of the market, all the ups and downs, then over the long run you should expect to receive this excess return. In this example here, that would be 5%, but clearly returns can be quite volatile. Lastly, beta, or beta if you're British or just one of those bankers that pronounces finance. It's a number that's meant to represent how risky a company is relative to the market. If your stock is half as risky as the market, you should expect to receive the risk-free rate plus only half of the market risk premium since you aren't taking that much risk. If your stock is twice as risky as the market, you should expect twice the market risk premium. Beta itself isn't a hard concept. The formula might look a bit tricky, but all it's basically doing is comparing the returns of the stock versus the returns of the market. Plotted together, if the returns on the investment are, on average, just as up on up days and just as down on down days, then the slope of this linear relationship is 1. This is the beta. If the stock's up days are more up than the market and down days are more down than the market, then the slope of this line of best fit is greater than 1. Now, I think beta and CAPM are great theoretical concepts, but their applicability to the real world has been heavily criticized. One of the main reasons is that beta doesn't necessarily reflect the real risk of a security. And even then, what is real risk? Is it volatility, permanent loss of capital, or bankruptcy? Tesla's stock has a higher beta than a lot of junior mining companies, but likely a much lower risk of bankruptcy. Or a stock might be much more volatile than another stock, but have a lower beta because it has a lower correlation to the market. If you ask me, the stock on the left here seems to be more risky, but CAPM will say that the one on the right is. It's even possible to have a negative beta, which doesn't really make any sense for CAPM. Professionals vary in their usage of CAPM, with some dogmatic and others completely dismissive. I, for one, was more on the art over science side, which was a lot easier when you had a fairly deep coverage of a space. For example, if I was using a cost of equity of 10% for one company and felt this other company was just a touch more risky, I might give it a 10.5 or an 11%. Voila. Going back to our example, a beta of 1.1 for our imaginary company would yield a cost of equity of 10.6%. Adding this final piece to our weighted average cost of capital gives us a value of 7.6%, and we are now able to discount our cash flows to value the company. But which cash flows? Now that we have an idea of the net present value calculation and understand what discount rate to use for a company, we need to figure out which cash flows to actually discount. A key consideration here is that we are looking for the intrinsic value of the company as a whole, and not just the value of its shares. This was evidenced by the fact that our weighted average cost of capital incorporates factors for both debt and equity, and in the same respect, we need to be looking for cash flows that accrue to all owners of the company, and not just equity holders. Using the income statement as a guide, we aren't looking at net income like we would if we just cared about equity holders, but rather a step higher before any debt holders are paid any interest. To investors, this is what we call EBIT, the company's earnings before interest and taxes. A more straightforward way to look at this would be to imagine that the company had just one owner. This EBIT figure would be the pre-tax income that they would receive. In a lot of ways, EBIT is the starting point for a discounted cash flow forecast, and verbally walking from EBIT to free cash flow is arguably the most common question interviewees for investment banking or equity research ever receive. The verbatim answer should always be EBIT after tax plus depreciation, less capex, and net change in working capital. And short of a few oligarchs' offspring or members of the royal family, no one has seen a second round interview having gotten that answer wrong. Now, we deduct taxes from EBIT because, as we've said before, we're looking at the company as a whole and not just the equity piece. Depreciation, the annual writing down of a company's fixed assets, counts as an expense to lower taxes, but doesn't actually represent any change in cash, so we can add back its impact on EBIT. Capital expenditures, or the money spent by a company to buy asset that it needs to run its business, represents a drain on the company's cash, but is excluded from EBIT. Neither is working capital, the amount of money tied up in the business to support its operations, such as inventory. The classical definition for working capital is accounts receivable, the money people owe the business but haven't yet paid and it's already calculated in the cash flow and the EBIT calculation, plus inventory, less accounts payable, the opposite of accounts receivable. The end result is that we've now arrived at the company's unlevered free cash flow. Unlevered meaning that we've stripped out the impact of the debt holders and built this model out to reflect all owners of the company. Now that we know what goes into estimating free cash flow, how far into the future do we actually have to project it? Well, the length of your DCF model will depend on the visibility you have into the future operations of a business. As an example, when I used to build models on pharmaceutical companies, like say Eli Lilly, I would typically forecast 10 years into the future. But if I was modeling a telehealth company like Teladoc, I might only forecast 7 years out. While big pharma isn't the most straightforward sector to predict, long patent cycles, robust epidemiological data and trends, and long-term visibility on competitor products due to a decade-long clinical trial approvals process make the future likely more predictable than the telehealth space, which is quite nascent, and the future market growth and competitive factors remain quite tough to call. Typically, I would say 7 years is the average for a DCF, but it can vary wildly. The best example is that of utility companies. Most of these businesses are tightly regulated by the government, which determines how much profit they can make. And as a result, they can accurately predict their cash flows 10, 20, and even 30 years down the road, nearly to the dollar. So now let's say, based on our level of confidence, we decide 7 years is the best forecast period. We are now ready to discount these cash flows using our previously calculated WACC of 7.6%. Firstly, I should state that since it's already September, we won't actually be getting a full year's cash flows here, so I designate that only 25% of the year's cash flows should be included in the valuation, and 100% for all future years. Next, the present value factor is the fraction that each period's future cash flows are worth today. To get to this, we divide 1 by 1 plus our WACC to the power of the year of the forecast. Adding all of these cash flows up for our company gives us a total value of $45,316. So now we've discounted the cash flows from our model, but this doesn't mean that we're saying the business just ends there. We have less visibility on the future, but we can't ignore it. The 7-year period is what we'll refer to as the explicit forecast period, where we are explicitly modeling each forecast year and their representative line items. Beyond this, we need to apply a reasonable set of assumptions to this future period to ascribe a value to the future cash flows the company will be receiving, which we will call the terminal value. Terminal values typically come in two forms. 1, a perpetual growth rate, which I'd say is more preferred by academics, and 2, an exit multiple, which is more preferred by the street and the buy side, the institutional investors and hedge funds. In the case of the perpetual growth rate model, this formula approximates the net present value of a stream of free cash flows that are growing at a fixed rate into infinity. For example, if we continue our DCF's forecast period, growing the free cash flows at a fixed growth rate forever, we would arrive at the same value as if we use this formula. This formula uses some of the figures we've already derived, like WACC and the company's last years of free cash flow. The only new figure here is the rate at which we grow these cash flows, which we will call the terminal growth rate, or often just terminal G, and listed here as G. Building on our previous example, a 2% growth rate here would imply a terminal value of $206,000. This figure, however, represents what the terminal value would be at the end of our explicit forecast period. So we now need to discount this back to today in the same way we did with the cash flows earlier. The cumulative number we arrive at by discounting the cash flows from our explicit forecast period plus the discounted terminal value is called the enterprise value, which here is $169,000. Conceptually, this is a nice, elegant way to approach the company's distant future cash flows, but a lot of practitioners take issue with the output being too dependent on a terminal G growth rate, which can be highly impactful on the firm's value. From our previous example, toggling the growth rate to 1% and 3% has a significant impact on valuation. The perpetual growth rate approach works best for companies with relatively predictable future growth. For example, if you're looking at an appliance company that has grown sales at 2% a year for the last 20 years, then a terminal growth rate of 2% might be appropriate. But if you're looking at a tech company where you figured the market would be growing at double digits for the next decade or two before settling into a mature market status of growth in the low single digits, then picking a terminal G of say 5% has no conceptual basis and is basically just a random guess. Alternatively, we might then prefer to apply the other type of terminal valuation, an exit multiple. Under this approach, we're saying that we think the future value of the company can best be approximated by a relative multiple valuation, usually enterprise value to EBITDA, at a point in the future immediately following our explicit forecast period. Let's walk through an example. Imagine the company we are valuing has several industry peers with varying levels of quality, leverage, and growth prospects. Our explicit forecast period for the company predicts strong growth, but this tapers off towards the end. By then, let's imagine that we think the company will have growth prospects, quality, and leverage comparable to that of company A and B. In that case, then perhaps it makes sense to take an average of the two to determine what multiple to use. That means a multiple of 12 times in this case. Before we go any further, I should state here that I'm using a 1-year forward multiple. I've seen people trying to justify using historical multiples, namely the company's last 12-month figure or LTM, but in a forecast like this, using forward multiples makes the most sense to me. I won't go into detail here, but check out the following video on multiples for more color on why using a multiple of the company's current valuation in conjunction with a forward-looking operating metric is more reflective of the market's outlook on the company than a current valuation with a historical or backwards-looking metric. The short answer is that investors don't care about the past. So now that we have a valuation multiple that we feel is appropriate, we need to apply it to our forecast to determine the terminal value. Note that because we are using a forward EBITDA figure, we actually have to add an extra year to our forecast for EBIT and depreciation in our model. In this example, applying our 12 times multiple to our $16,000 value for EBITDA gives us a terminal value of $195,000. Again, this is essentially saying that we think the company will be worth this much at the end of the forecast period, so we need to discount this back to today for the value to have any meaning. Recall from earlier that this combined amount represents our estimate of the company's enterprise value, the value of the company as a whole regardless of the type of capital contributed, namely debt or equity. While this is informative, typically we do a valuation to work down to the intrinsic values of the shares, basically our target price. To do this, we first need to convert this figure into an equity value. The simplified formula for enterprise value is that it's equal to the value of the company's equity plus its debt less its cash. So for our example here, we can just invert this formula. In this case, we subtract the $50 million in bonds that we mentioned when calculating our WACC, and also add back $15 million in cash that the company has on its balance sheet. This gives us an equity value of $127,000. Dividing this by the fully diluted shares outstanding gives us a figure of $98.05 per share. This is our target price, also known as our estimated intrinsic value per share. Alright, so that's all we got for today. We walked through a valuation using a discounted cash flow, but remember that's not the only way to value a company. In fact, in our subsequent video we go through some other methodologies, so be sure to check that out too. Finally, remember there's a link in the description to a downloadable DCF template you can play along with at home. Thanks for tuning into Market Lab.